Hello, fellow traders. I understand that trading can be a roller coaster. Today, we're tackling a tough but essential topic: how to bounce back after trading losses. This isn't just about recouping money. It's about rebuilding your mindset, strategy, and confidence. Let's turn to setbacks into setups for future success. Today, we're going to get into recovery strategies, bouncing after trading losses by a pajama trader. Give this a like and subscribe. Let's get into it. Acknowledge the loss, the market reality. Trading losses are a painful but inevitable part of the game. Ignoring them is not an option. Look at the SPY chart. Notice the sharp drop back in early April, plummeting from around 576.79 to 481.80 in a short span. Many traders likely experienced significant losses during this downturn. The takeaway here is that even in a generally upward trending market like the SPY or S&P 500, sudden and substantial corrections can occur. Acknowledging this possibility is the first step in preparing for and recovering from such events. Understanding the cause, the autopsy of a trade. Review your trades with cold hard objectivity. Identify specific mistakes in your entry, exit, or position sizing without self-blame. Differentiate between flawed strategies and unpredictable market conditions. Let's say you're trading the SPY during that early April drop. Ask yourself, did you have a stop loss in place? If so, was it too tight, triggering prematurely? Did you try to buy the dip around March 21st without confirmation, only to see it fall further in April? Or were you simply caught off guard by the speed and the severity of the decline? Understanding these factors is crucial. For instance, if you were using a moving average crossover strategy and it failed, was it because the market conditions changed, rendering your strategy ineffective at the time? Risk management is your armor. Always use stop loss orders to protect your capital. No exceptions. Never risk more than you can realistically afford to lose on a single trade. Dramatically adjust your position size based on your risk tolerance and market volatility. Referring to that SPY drop, imagine if you had a 2% stop loss on your SPY position at 576. That would have limited your loss to approximately $11.53 per share, allowing you to exit the trade before the massive decline. Without that stop loss, you would have suffered a loss of $94.99 per share. This illustrates the power of a well-positioned stop loss order, also recognizing when market volatility is increasing, like leading up to that drop. And consider reducing your position size to mitigate the potential losses. Continuous learning, the edge you need. Stay updated with the latest market trends, analysis techniques, and trading tools. Continuously refine your trading strategies based on market conditions and personal performance. Never stop learning and adapting to maintain a competitive edge. After experiencing a loss during that SPY drop, a smart trader would analyze what indicators would have warned them of the impending downturn. Where there were divergences in the RSI leading up to the decline, was the volume declining as the price initially consolidated in March? Did the MACD signal a bearish crossover that you might have missed? By studying these indicators and incorporating them into your future analysis, you're continuously learning and improving your trading strategy. Thanks again for watching.